2025 IRS Tax Filing Update. The Internal Revenue Service recently provided its tax filing update and suggestions for U.S. taxpayers, providing a series of tips and reminders to speed taxpayer refunds and avoid errors on their federal tax returns as the April 15, 2025 filing deadline approaches for individual tax returns for 2024 income. Most of these suggestions from the IRS make a lot of sense, but it is always advantageous to review them and be reminded of best practices in relation to filing your personal income tax return and possibly picking up a new tip or two, or avoiding a possible mistake that could be quite disruptive. Collect all tax-related paperwork. Taxpayers should gather all documents including W-2s, 1099s, and other information returns, as well as any supporting paperwork for tax deductions or credits, such as educational credits or mortgage interest payments. Having the previous year's tax return accessible is also advised, as it may be required. Taxpayers can also check their IRS individual online account to view their Form W-2, wage and tax statement, and Form 1095-A, Health Insurance Marketplace Statement, under the Records and Status tab in the taxpayer's individual online account. Ensure filing status, names, birth dates, and Social Security numbers are correct. Taxpayers must accurately provide the name, date of birth, and Social Security number for each dependent listed on their individual income tax return. The Social Security number and individual's name should be entered precisely as indicated on the Social Security card. In cases where a dependent or spouse lacks a Social Security number and is ineligible to obtain one, an assigned individual tax identification number, ITIN, should be listed instead of a Social Security number. Use electronic filing. The Internal Revenue Service advises taxpayers and their tax advisors to use electronic filing methods such as IRS Free File fillable forms, or with Direct File. Electronic filing decreases mathematical errors, identifies potential tax credits or deductions for which the taxpayer qualifies, and prompts taxpayers for missing information. Opting for electronic filing and selecting direct deposit is the fastest and safest way to receive a refund. While taxpayers and tax professionals are urged to choose electronic filing when filing individual tax returns, there are taxpayers who must submit a paper tax return. It is essential that paper filers verify the accurate mailing address either on irs.gov or in the instructions provided with Form 1040 to prevent processing delays. Report all taxable income. Most income is subject to taxation. Failing to accurately report income may result in interest and penalties. Taxable income includes various sources of income, such as interest earnings, unemployment benefits, and income derived from service industry, gig economy, and digital assets. For further details, consult Publication 525, Taxable and Non-Taxable Income. Answer the digital assets question. Everyone who files Form 709, 1040, 1040-SR, 1040-NR, 1041, 1065, 1120, and 1120-S must check one box answering either yes or no to the digital asset question. The question must be answered by all taxpayers, not just by those who engage in a transaction involving digital assets in 2024. Taxpayers must report all income related to digital asset transactions. Visit the digital assets page on irs.gov for details on when to check yes and how to report digital asset transactions. Make sure banking routing and account numbers are correct. Taxpayers have the option to request direct deposit of a federal refund into 1, 2, or even 3 accounts. For taxpayers who do not have a traditional bank account, Some mobile apps and prepaid debit cards have routing and account numbers that allow for direct deposit of tax refunds. When expecting a refund, ensure the routing and account numbers provided for direct deposit are accurate to avoid delays or misdirected refunds. Remember to sign and date the return. When submitting a joint return, both spouses must sign and date the return. If taxpayers are preparing their taxes independently and filing electronically, they need to sign and authenticate their electronic tax return by inputting their adjusted gross income from the prior year. For more guidance, visit Validating Your Electronic Tax Return. Need to make a payment. Tax payments are still due on April 15th for most taxpayers. Payments can be made using individual online account, direct pay, the Electronic Federal Tax Payment System, EFTPS, or with a debit, credit card, or digital wallet. By doing so, taxpayers avoid the necessity of filing a separate extension form and receive a confirmation number for their records. Request an extension if needed. Taxpayers requiring more time to file their taxes can easily request a 6-month extension until October 15th. The IRS offers 3 options to request an extension to file. 1. Pay what you owe using an online payment option and check the box that you are paying as part of filing for an extension. 2. Request it at no cost either through IRS Free File, regardless of income, or 3. By submitting Form 4868, application for automatic extension of time to file U.S. individual income tax return by April 15th. While an extension avoids late filing penalties and provides extra time for filing, an extension of time to file is not an extension of time to pay. Taxpayers can seek an extension to file by making a full or partial payment of their estimated income tax and indicating that the payment is for an extension. Many taxpayers may have more time to file if they were affected by a disaster situation. Visit Tax Relief in Disaster Situations for information on the most recent tax relief provisions based on FEMA's declarations. Keep a copy of the tax return. Taxpayers should maintain copies of their signed returns and any accompanying schedules for their personal records and to help them prepare future tax returns and figure mathematical computations in the event they have to file an amended return. Typically, taxpayers should retain records supporting income, deductions, or credits claimed on their tax return until period of limitations for the specific tax return expires. Remember that these are but a few of the tips that are available from the IRS, which are exceedingly generic and designed for the greatest number of U.S. taxpayers. When it comes to actual questions related to your U.S. income taxes and filing of your personal income tax return, you should be speaking directly with the IRS or a knowledgeable professional. For more informative videos on tax matters and related topics, we welcome you to subscribe to our channel as well as liking this video. Thank you. Top 10 individual taxpayer mistakes on 1040 income tax returns according to the IRS. Given that we are past the government financing arrangements that were provided during the COVID-19 pandemic, we would not be looking at the massive amount of errors that arose from the one-time tax credit, which allowed taxpayers who did not receive economic impact payments or less than the full amount they were entitled to claim a credit on their tax return. The 2 primary causes for math errors in the recovery rebate credit were that the second economic impact payment was issued after many taxpayers had already prepared their tax year 2020 tax returns, and that many taxpayers incorrectly calculated their allowable recovery rebate credit amount or claimed a credit that they were not entitled to. This resulted in 11,372,980 errors being identified, representing 87.9% of the errors identified by the IRS for tax filings for the 2020 tax year. Mistakes that we will be looking at are in addition to some other common mistakes which are not contained in this IRS statistical data, such as filing too early and missing subsequent information from your submission, filing late, thus delaying the processing and subjecting oneself to interest and penalties, misspelling your name, incorrectly entering your Social Security number, providing an incorrect bank routing number, failing to sign all signature lines on your tax forms, and collecting and using all the tax-related information that you need to complete your income tax return. The Internal Revenue Service provides a considerable amount of publications and instructional materials that are regularly updated to reduce the occurrence of many of the mistakes that the Internal Revenue Service has identified, with the current year's 1040 instructions being a key starting point. Now on to the mistakes as identified statistically by the Internal Revenue Service. Mistake number 10, adjustments to income. 2.1% of errors for the 2019 tax year filing, representing 24,463 occurrences. Schedule 1 of IRS Form 1040 provides the taxpayer with certain permissible expenses, payments, contributions, fees, etc., that they might subtract from their total income, with the difficulty arising in making those adjustments in strict conformity with the established parameters of the Internal Revenue Service. The IRS's current year 1040 instructions provides an expansive depiction of adjustments to income with important worksheets for key aspects. Mistake number 9, refund amount owing. 2.4% of the errors for 2019 tax year filing, representing 27,860 occurrences. A mathematical miscalculation of the final amount, either being a refund or amount owed to the Internal Revenue Service. Mistake number 8, filing status. 3.1% of the errors for 2019 tax year filing, representing 36,861 occurrences. There are 5 classifications for an individual taxpayer's filing status: single, married filing jointly, married filing separately, head of household, and qualifying surviving spouse. And even though the IRS says, quote, if more than one filing status applies to you, choose the one that will give you the lowest tax, end quote, the critical aspect is that you need to actually qualify for it. Otherwise, you can get less of a refund than you are otherwise entitled to, or the IRS might flag your tax return. IRS Publication 501, Dependents, Standard Deductions, and Filing Information, provides an exceedingly detailed analysis as to determining one's filing status. Number 7, first-time home buyers credit repayment. 4.3% of the errors for 2019 tax year filing, representing 50,334 occurrences. The repayment obligation arises in the tax year that the taxpayer either disposes of the home or its use as the taxpayer's main home has ceased. Those taxpayers would benefit from reviewing the IRS instructions for Form 5405 in furtherance of the preparation of IRS Form 5405, repayment of first-time homebuyers credit. Mistake number 6, standard itemized deductions. 6.1% of the errors for 2019 tax year filing, representing 71,648 occurrences. Going overboard with respect to the amount of itemized deductions that an individual taxpayer believes that they are entitled to is where many taxpayers run into problems, such that they should be scrutinizing those itemized deductions against the IRS's stated position as set out in Schedule A, Form 1040, instructions. In addition to there being certain individuals who cannot claim the standard deduction due to clear situational issues that have been identified by the IRS, see IRS Publication 501. Mistake number 5, earned income tax credit. 6.4% of the errors for 2019 tax year filing, representing 74,936 occurrences. The Earned Income Tax Credit is a tax credit for certain people who work and have earned below a threshold income level, which is impacted by various circumstances, in particular based upon the number of qualifying children that one has. This too is prone to complexity, such that it is advisable to look to IRS Publication 596, Earned Income Credit, starting with Table 1, Earned Income Credit in a Nutshell, and the Earned Income Credit Eligibility Checklist. Mistake number 4, education credits. 6.5% of the errors for 2019 tax year filing, representing 76,798 occurrences. As one can well anticipate, education tax credits can be quite complex, especially as there is more than one tax credit that is made available to individual taxpayers, with the specifics of their personal situation needing to be addressed in the determination of eligibility and credit amount. IRS Publication 970, Tax Benefits for Education, provides a comprehensive overview as to the IRS's position on education tax credits. Mistake number 3, adjusted gross and taxable income amount. 12.2% of the errors for 2019 tax year filing, representing 143,587 occurrences. When the taxpayer takes deductions for which they are ineligible or do not apply to their tax situation, this impacts their adjusted gross income and taxable income, as is the case with tax credits, such that this precipitates computational errors that continue to flow through the income tax return and results in errors arising with the Internal Revenue Service. Mistake number 2, child tax credit miscalculations. 17.5% of the errors for 2019 tax year filing, representing 205,594 occurrences. The top 5 reasons for this particular error are: 1, your child doesn't qualify; 2, more than one person claimed the child; 3, social security number or last name don't match; 4, married and filed as single head of household; and 5, over or underreporting your income or expenses. The qualification rules are all too frequently not satisfied, with those requirements being: 1, relationship, your child must be related to you; 2, residency, your child must live in the same house as you for more than half the tax year; 3, age, your child's age and student or disability status will affect if they qualify; and 4, joint return, your child must not file a joint return with another person, for example their spouse, to claim the EITC. IRS Publication 501 provides a very in-depth analysis as to what qualifies as dependency relationship and who is entitled to the child tax credit, starting with Table 5, Overview of the rules for claiming a dependent. Mistake number 1, mathematical error in tax calculations. 35.2% of the errors for 2019 tax year filing, representing 415,875 occurrences. Mathematical errors combined with inputting the incorrect numbers into one's calculations tends to be the overwhelming issue that the Internal Revenue Service sees with individual tax returns. And the problems aren't entirely limited to the taxpayer, given that employers and other parties that prepare tax slips filed with the IRS can miscalculate on their end or input tax information incorrectly, such that there is a range of reasons for these mathematical errors to arise and cause problems with the individual taxpayer's income tax return. Thank you. What is IRS Form 1040, U.S. Individual Income Tax Return? The Internal Revenue Service, IRS Form 1040, is the United States of America's individual income tax return. The IRS Form 1040 enables the taxpayer to calculate their taxable income and the tax on that income so as to either claim a refund or pay income tax due for the relevant tax year. There are presently 4 forms of the 1040 that are available to taxpayers, with the principal form 1040 being the one that the majority of taxpayers will utilize. with Form 1040 SR being used by senior taxpayers, 65 years of age and older, Form 1040 NR being used by non-resident aliens, and Form 1040X being for taxpayers who need to make amendments to their tax return after previously filing a Form 1040. The IRS Form 1040 is itself only 2 pages in length. However, depending upon the complexity of the individual taxpayer's income, benefits, and credit situation, the number of supporting schedules can become quite extensive. These schedules and associated supporting documentation that is appended to the 1040 can be quite substantial. Nevertheless, for purposes of this particular video, we are focusing exclusively upon the 2 pages that are the IRS Form 1040. As with most tax forms created by the Internal Revenue Service, IRS Form 1040 commences with a significant identification section. The aspect that naturally requires the most consideration is the designation of one's filing status, with the classifications being married filed separately, single, head of household, married filing jointly, and qualifying surviving spouse, listed from what is typically the highest to lowest taxation according to the IRS. Each of the classifications have specific criteria that should be reviewed and are set out in the IRS published 1040 instructions. As one might expect, with the rise of Bitcoin and cryptocurrencies, the Internal Revenue Service is intent on tracking and dealing with it under the heading of digital assets. As the IRS sees it, quote, digital assets are any digital representation of value that are recorded on a cryptographically secured digital ledger or any similar technology. For example, digital assets include non-fungible tokens, NFTs, and virtual currencies, such as cryptocurrencies and stable coins. If a particular asset has the characteristics of a digital asset, it will be treated as a digital asset for federal income tax purposes. End quote. The standard deduction section addresses those limited scenarios where the taxpayer might be claimed by another individual as a dependent, or their older age or blindness provides them with special tax treatment. Next, the individual taxpayer needs to look at whether a person qualifies as a taxpayer's dependent, and to find out if their dependent qualifies the taxpayer to take the child tax credit or the credit for other dependents. The IRS provides a very detailed 5-step procedure for making such a determination, together with special rules and definitions in the IRS published 1040 instructions. The income section mandates that the individual taxpayer must report all income, with certain income forms requiring a listing of the full income in that portion which is taxable. This leads to the computation of total income, which is set out at line 9. The taxpayer then deducts their adjustments to income, which were computed on Schedule 1, to arrive at their adjusted gross income at line 11. The taxpayer either deducts a standard deduction or their itemized deductions from Schedule A, together with their qualified business income deduction, if applicable, to arrive at their taxable income, which is set out at line 15. Extensive details are provided in the IRS published 1040 instructions and the Schedule 1 instructions, with the individual taxpayer also benefiting from reviewing the very comprehensive IRS publication 525, Taxable and Non-Taxable Income. One then proceeds to the tax and credit section to determine their taxes at line 16, plus additional taxes from Schedule 2, line 3, less child tax credit or credit for other dependents from Schedule 8812, less non-refundable credits from Schedule 3, line 8, which amount, if negative, is zeroed out, plus any other taxes, including self-employment tax from Schedule 2, line 21, to arrive at the taxpayer's total tax. This leads to the payment section, which determines how much was paid and or credited, such as with the Earned Income Credit, Additional Child Tax Credit, and American Opportunity Credit, against your tax liability, resulting in your total payments. If the taxpayer's total payments exceed their total tax, then the taxpayer is entitled to a refund, and they proceed with completing the refund section to direct the Internal Revenue Service as to how they are to process the taxpayer's refund. If the taxpayer's total taxes exceed their total payments, the taxpayer must remit the difference following the instructions as set out in the Amounts You Owe section. The balance of the IRS Form 1040 involves authorizations, designations, and signature blocks related to third-party designees, paid preparers, the spouse of a joint return, and the taxpayer. There is extensive material made available by the Internal Revenue Service on their website that is designed to assist the taxpayer with the preparation of IRS Form 1040, including instructions, publications, and online tools. There are also many third-party publications and resources available to taxpayers. Finally, there are tax return preparers capable of tackling one's income tax return, with the IRS providing an online directory of federal tax return preparers with credentials and select qualifications on their website at irs.treasury.gov/rpo/rpo.jsf. Thank you. Income Tax Return Preparation, IRS Guidance Before Completing Your 1040. The Internal Revenue Service, IRS, does provide some very sage advice that we may all well know, yet it needs to be reinforced and reminded of, which is of considerable value to reiterate when one is looking to complete their individual income tax return on IRS Form 1040. And this goes to one's preparation in advance of completing their personal income tax return. Taxpayers should have all their pertinent and necessary documents before undertaking the preparation of their personal income tax return. This helps people file a more complete and accurate income tax return, so as to hopefully avoid overlooking available deductions or credits, thereby minimizing one's tax liability. Errors and omissions slow down tax processing, including the time to process a taxpayer's refund. Among the documentation pertinent to the preparation of one's personal income tax return, IRS Form 1040, the taxpayer should be looking at collecting and organizing the following materials: IRS Form W-2, Wage and Tax Statement from your employers; IRS Form 1099 NEC, Non-Employee Compensation for working as an independent contractor; IRS Form 1099 MISC, Miscellaneous Information for self-employment income; IRS Forms 1099 from banks, issuing agencies, and other payers, including unemployment compensation, dividends, pension, annuity, or retirement distribution plans, including IRS Form 1099 DIV, Dividends and Distributions, and IRS Form 1099-R, Distributions from pensions, annuities, retirement or profit-sharing plans, IRAs, insurance contracts, etc. IRS Form 1099-K, Payment Card and Third-Party Network Transactions; 1099 MISC, Miscellaneous Information; W-2 or other income statement if you worked in the gig economy; IRS Form 1099 INT, Interest Income if you were paid interest; IRS Form 1099-S, Proceeds from Real Estate Transactions as it relates to your real estate transactions; other income documents and records of digital asset transactions; IRS Form 1095-A, Health Insurance Marketplace Statement to reconcile advance payments or claims premium tax credits for 2022 marketplace coverage; IRS Form W-2G for certain types of gambling winnings; tax deduction documentation such as IRS Form 1098, mortgage interest statement, IRS Form 1098-E, student loan interest statement, IRS Form 1098-T tuition statement for tuition paid on post-secondary education. Receipts for expenses where you're claiming those deductions, including medical bills, charitable contributions, IRA contributions, and certain education expenses. Premiums paid for long-term care insurance. Documentation of casualty losses if you lived or owned property in a federally declared disaster area. Real estate taxes, state and local income taxes, sales taxes. IRS Form 1040-ES, estimated tax for individuals, for a record of tax payments made. Letters from the Internal Revenue Service, other tax authorities, and other government agencies. You should be reviewing these materials early on so as to ensure that your name is spelled correctly and the correct Social Security number has been entered, as errors with your copy invariably means there is a similar error in the copies provided to the IRS and state and local tax authorities, which needs to be corrected by the originator to avoid processing delays and other potential problems. As such, it is always advisable to properly retain these materials through the course of a year and to collect them and put them before yourself before you undertake the preparation of your IRS Form 1040 income tax return, together with all the supplemental material that you need to prepare and submit to the Internal Revenue Service. Thank you. Top IRS tax credits, IRS rankings. In this video, we look at the results of the Internal Revenue Service's statistical analysis of U.S. personal income tax returns to identify the top tax credits claimed by American taxpayers. As a quick reminder, tax credits are used to offset taxes, with certain tax credits being refundable, such that where the amount of the credit exceeds the total tax owed, the excess credit can be refunded to the taxpayer. Furthermore, the U.S. federal government has been fluctuating around with the non-refundable versus refundable status of various tax credits in the past few years, such that it is important to review the current status of a particular tax credit, given that we are looking at statistical data from a single point in time and based upon a broad sweep that is undertaken for purposes of statistical analysis, as opposed to individual application for a given taxpayer in a particular year. Number 1, Child and Other Dependent Tax Credit. In 2020, the Child and Other Dependent Tax Credit was the most claimed tax credit, being claimed on 39,300,000 income tax returns and constituting $84.4 billion in non-refundable tax credits. For analytical purposes, it is viewed exclusive of the refundable additional child tax credit, which will be addressed at number 4. The credit is provided to taxpayers that paid expenses for the care of a qualifying individual to enable the taxpayer and their spouse, if filing a joint return, to work or actively look for work. IRS topic numbers 602 and IRS publication 503 are excellent resources for the Child and Other Dependent Tax Credit. Number 2, Recovery Rebate Credit. Introduced for the 2020 tax year, the Recovery Rebate Credit was the second highest tax credit and highest refundable tax credit, being claimed on 31,096,000 income tax returns and constituting $45.4 billion in refundable tax credits. This COVID-era tax credit was provided to taxpayers that missed a stimulus payment, economic impact payment, or got less than the full amount, were potentially eligible to claim a recovery rebate credit on their 2020 or 2021 federal tax return, with IRS publication 5,486 being a good starting point. Number 3, Earned Income Tax Credit. The Earned Income Tax Credit was the third highest tax credit in 2020, although in prior years tended to be the second highest tax credit and highest refundable tax credit, being claimed in 2020 on 26,026,000 income tax returns and constituting $59.2 billion in refundable tax credits. The Earned Income Tax Credit helps low-income to moderate-income workers and families get a tax break, supplementing their wages and offsetting the impact of the Social Security tax. IRS Publication 596 provides an expansive look at the Earned Income Credit. Number 4, Additional Child Tax Credit. The Additional Child Tax Credit was the fourth highest tax credit in 2020, being claimed on 19,119,000 income tax returns and constituting $33.6 billion in refundable tax credits. The Additional Child Tax Credit is the refundable portion of the child tax credit that can be claimed by families who owe the IRS less than their qualified child tax credit amount. Number 5, Retirement Savings Contribution Credit. The Retirement Savings Contribution Credit was the fifth highest tax credit in 2020, being claimed on 9,401,000 income tax returns and constituting $1.75 billion in non-refundable tax credits. The Retirement Savings Contribution Credit is available in certain circumstances for taxpayers making certain contributions to an employer retirement plan or an individual retirement arrangement (IRA), or contributions to an Achieving a Better Life Experience (ABLE) account, of which the taxpayer is the designated beneficiary. See IRS Publication 590-A for more. Number 6, Foreign Tax Credit. The Foreign Tax Credit was the sixth highest tax credit in 2020, being claimed on 9,201,000 income tax returns and constituting $21.6 billion in non-refundable tax credits. As discussed in IRS Publication 514, taxpayers that paid or accrued foreign taxes to a foreign country or U.S. possession and are subject to U.S. tax on the same income may be able to take either a credit or an itemized deduction for those taxes. Number 7, non-refundable education credits. Seventh in 2020 were non-refundable education credits, being claimed on 7,419,000 income tax returns and constituting $7.8 billion in non-refundable tax credits. An example of a non-refundable education credit is the Lifetime Learning Credit, which is for qualified tuition and related expenses paid for eligible students enrolled in an eligible education institution. Number 8, American Opportunity Credit. The American Opportunity Credit was the eighth highest tax credit in 2020, being claimed on 6,481,000 income tax returns and constituting $5.6 billion in refundable tax credits. The American Opportunity Tax Credit is a refundable tax credit for qualified education expenses paid for an eligible student for the first 4 years of higher education. Number 9, Child Care Credit. The Child Care Credit was the ninth highest tax credit in 2020, being claimed on 5,050,000 income tax returns and constituting $2.8 billion in non-refundable tax credits, although its distinction from the child and other dependent tax credit is not made entirely clear when one reviews IRS Publication 503, Child and Dependent Care Expenses, and assesses it against a statistical presentation of the IRS in Publication 1304. Number 10, Residential Energy Credit. The Residential Energy Credit was the 10th highest tax credit in 2020, being claimed on 2,291,000 income tax returns, constituting $3.9 billion in non-refundable tax credits. Residential energy credits include both non-business energy property credits and residential energy efficient property credits, with IRS instructions for Form 5695 being an excellent starting point. Thank you. What is tax season? The tax season, from the perspective of the Internal Revenue Service, IRS, is a period of approximately 12 weeks during which the IRS will receive for filing and processing personal income tax returns, IRS Form 1040, until the final remittance date in mid-April every year. This, however, is the timeline for the administrative state as it relates to their internal work schedule, such that for most taxpayers it is only an indication as to when they might start filing their personal income tax returns, provided that they have received all their necessary tax information, so as to complete IRS Form 1040 and all applicable schedules. In truth, for most taxpayers, Tax season is dictated by when actions need to be taken to legally minimize the taxpayer's tax liability. As such, tax season for most individual taxpayers might properly be broken down into two time slots, with the first being the end of the applicable tax year and the second being prior to the tax filing deadline once the taxpayer is in receipt of all their tax information, such that they might file their income tax return. This initial phase in December, which represents the end of the tax year and is also the end of the calendar year for individual taxpayers, needs to be dedicated to positioning oneself to optimize their financial position and legally limit their tax liability. This means looking at available credits and deductions that might be realized by undertaking specific purchases and transactions, including contributions to various retirement and investment arrangements, donations to charities, and other appropriate actions. This is a tax planning phase that is highly particular to the specific taxpayer. The next phase for most taxpayers involves collecting, preparing, and filing their income tax return. This is in large part dictated by the availability of tax information from employers, investment companies, government agencies, and other income sources, all within the time frame set by the IRS. This ranges from W-2s to various 1099s, including 1099 NEC, 1099 Miscellaneous, and 1099-K. This is the core of the individual taxpayer's tax season, with the key being to complete the work and filing prior to the ever-advancing deadline of the IRS. Thank you.
What is IRS Free File? IRS Free File was designed as a quick and easy way for U.S. taxpayers to prepare and file their federal income tax returns for free. IRS Free File allows qualified U.S. taxpayers to gain the benefit of free tax preparation, free electronic filing, and free direct deposit of their federal tax refund, if they're owed one, using guided tax preparation software available at irs.gov. IRS Free File is available to U.S. taxpayers and families whose 2024 total adjusted gross income was $85,000 or less. A taxpayer's adjusted gross income includes wages, tips, business income, retirement income, and other forms of taxable income. Through a public-private partnership between the IRS and the Free File Alliance, tax preparation and filing software providers make their online products available to eligible taxpayers. Each income tax software provider sets its own eligibility rules based on age, state residency, and income, while IRS Free File will guide U.S. taxpayers through the process of choosing the appropriate tax software provider for their needs. Benefits of IRS Free File. Using IRS Free File can help taxpayers find and calculate valuable tax credits like the Earned Income Tax Credit, Child Tax Credit, and the Child and Dependent Care Credit. Any individual or married couple that meets the income limitation is potentially eligible, and IRS Free File can also handle complex tax returns. IRS Free File partner companies cannot disclose or use tax return information for purposes other than tax return preparation without the taxpayer's informed and voluntary consent. Taxpayers can use IRS Free File to file their taxes on any personal computer, tablet, or smartphone. All the tax software products are available in English, and one guided tax product is available in Spanish. Easy way to file an extension. Need more time to file? IRS Free File is one of the easiest ways to request an extension. A tax filing extension guarantees a taxpayer 6 additional months to file with an extended deadline of October 15th. Although an extension grants extra time to file, it does not grant taxpayers extra time to pay if they owe. Taxpayers are still obligated to pay taxes due on April 15, 2025 to avoid penalties and interest. Taxpayers who owe should either pay their full tax bill or at least pay what they can afford by the April 15th deadline. Other free tax filing options. In addition to IRS Free File, the IRS has identified other free tax preparation filing programs available to help U.S. taxpayers, including Free File Fillable Forms. All taxpayers, regardless of their income, can use the IRS's Free File Fillable Forms. These are the electronic versions of IRS paper forms and are best for people who are comfortable preparing their own taxes using IRS forms and instructions. Direct File. Taxpayers who lived and worked in one of 25 participating states for all of 2024 may use IRS Direct File to file federal tax returns online for free, directly and securely with the IRS. Go to IRS Direct File to find more information, including eligibility requirements and updates to the list of tax situations added to IRS Direct File for the 2024 tax year. VITA and TCE. People who generally make $67,000 or less, persons with disabilities, limited English-speaking taxpayers, and those who are 60 years of age and older can also find free one-on-one tax preparation help around the nation through the Volunteer Income Tax Assistance, VITA, and Tax Counseling for the Elderly, TCE, programs. VITA, TCE sites are operated by IRS partners and staffed by IRS certified volunteers who provide a trusted source for preparing tax returns. MIL Tax. Offered through the Department of Defense, MIL Tax is a free tax resource available to members of the military, as well as qualifying veterans and family members. It is a suite of tax services designed to address the realities of military life, including deployments, combat and training pay, housing and rentals, and multi-state filings. MIL Tax includes tax preparation and electronic filing software, personalized support from tax consultants, and current information about filing taxes. Eligible taxpayers can use MIL Tax to electronically file a federal tax return and up to 3 state returns for free. More information about IRS Free File is available at the Internal Revenue Service's website, irs.gov. For more informative videos on tax matters and related topics, we welcome you to subscribe to our channel as well as liking this video. Thank you. What is the Earned Income Tax Credit, according to the IRS? The Earned Income Tax Credit, or Earned Income Credit, is a tax credit that is available to low-income and moderate-income wage earners and families in the United States of America who meet criteria established by the Internal Revenue Service. The U.S. federal government conceptualized the Earned Income Tax Credit as a work bonus plan intended to supplement the wages of low-income and moderate-income workers and thereby helps offset the effect of Social Security taxes. Considering its financial significance to many low-income wage earners, it is accordingly viewed as an anti-poverty tax benefit. Through the end of December 2022, as to the IRS's processing of 2021 income tax returns, there were approximately 31 million taxpayers that claimed the Earned Income Tax Credit, representing some $64 billion in earned income tax credits. This represents a national average of $2,043 received per claimant. The IRS in actuality contends that some 25% of eligible taxpayers actually fail to claim the Earned Income Tax Credit. Many taxpayers actually slide into the qualifying criteria when they lose their job, take a pay cut, reduce their hours of work, or take substantial time off, as these events can result in a drastic reduction in one's yearly wages and all too often unknowingly qualify the taxpayer for the Earned Income Tax Credit. The IRS further estimates that about 1/3 of the EITC eligible population turns over each year, making it important for potential claimants to review their eligibility each and every year. The qualifying criteria for the Earned Income Credit is predicated on the taxpayer's adjusted gross income relative to their marital status and the number of dependents that they are responsible for. Their marital status and number of children dependents also determines the amount of EITC that they are entitled to claim. A single taxpayer with no children or other dependents could thus be eligible for the Earned Income Credit. However, their income threshold will be the lowest amongst eligible taxpayers with the least amount of available credit, especially following the reduction that came about with the temporary boost that had been provided in the 2021 tax year under the American Rescue Plan, which provided a one-year tripling of the EITC for qualifying childless workers who only had to be 19 years of age or older, as opposed to the normal 25 years of age or older. The Earned Income Tax Credit is for workers whose adjusted gross income does not exceed the following limits in 2022. $53,057 for those with 3 or more qualifying children with valid Social Security numbers, boosted up to $59,187 for married filing jointly. $49,399 with 2 qualifying children who have valid Social Security numbers, but boosted up to $55,529 for those married filing jointly. $43,492 with 1 qualifying child who has a valid Social Security number, but boosted up to $49,622 for those married filing jointly. And $16,480 with no qualifying children who have valid Social Security numbers, boosted up to $22,610 for married filing jointly. Further requirements for attaining the Earned Income Tax Credit applicable to all claimants. The taxpayer must have earned income. The taxpayer must have a valid Social Security number by the due date of their 2022 income tax return, including extensions. The taxpayer must meet certain requirements if they are separated from their spouse and not filing a joint return. The taxpayer must be a U.S. citizen or resident alien all year. The taxpayer cannot file IRS Form 2555 relating to foreign earned income. A further requirement for claiming the EITC is that taxpayer's investment income must be $10,300 or less, and the Earned Income Tax Credit age eligibility is 25 years of age or greater. Added requirements if the taxpayer has a qualifying child. Each qualifying child must meet the relationship, age, residency, and joint return tests. Each qualifying child cannot be used by more than one person to claim the Earned Income Tax Credit, and the taxpayer claimant cannot be a qualifying child of another person. Added requirements if the taxpayer has no qualifying children. The taxpayer must meet the age requirements. The taxpayer must be the dependent of another person. The taxpayer cannot be a qualifying child of another person, and the taxpayer must have lived in the United States more than half the year. For 2023, the Internal Revenue Service set out the following credit ranges associated with 2022 income tax returns. Up to $6,935 for 3 or more qualifying children. Up to $6,164 for 2 qualifying children. Up to $3,733 for 1 qualifying child, and up to $560 for no qualifying children.
And as the IRS appropriately points out, even where a taxpayer is eligible for the Earned Income Tax Credit, they should not discount the possibility of being entitled to other tax credits, in particular other child-related tax credits. Thank you. The standard deduction versus itemized deductions claimed on IRS Form 1040 individual income tax return. As one might well anticipate, individual taxpayers seeking to better understand claiming the standard deduction versus itemized deductions want to understand what other taxpayers across the United States are doing and understand where there might be value in proceeding with one approach to offsetting their personal taxes as against another approach, even though their individual circumstances are absolutely critical, such that we look at statistical information provided by the Internal Revenue Service to better understand the choice in taxpayer deductions. And this is a pretty significant realm, given that the total amount of such deductions, being the sum of standard deductions composed of basic standard deduction, the additional standard deduction for blind or the elderly, and the disaster loss standard deduction, and total itemized deductions had risen to $3.1 trillion for the 2020 tax year. Now, from a purely empirical perspective, 87.3% of individual income tax returns filed in 2021 for the 2020 tax year claimed a standard deduction, with the standard deduction accounting for 80.4% of the total monetary amount of these deductions. The average standard deduction that individual taxpayers were able to claim increased from $17,021 for tax year 2019 to $17,383 for tax year 2020. In sharp contrast, individual taxpayers only claimed itemized deductions on 9.5% of filed income tax returns. Although this segment of taxpayers, representing less than 1/10 of the individual tax filers, accounted for 19.6% of the total monetary amount of these deductions. As such, the average total of itemized deductions was $39,105 for 2020, up from the $37,184 average total claimed for 2019, meaning that taxpayers were claiming on average 2.25 times in itemized deductions as were taxpayers claiming the standard deduction. However, as the IRS's own statistical analysis identified, the number of income tax returns with itemized deductions decreased 10.5% from 2019 to 2020 to 15.5 million income tax returns. The order of top itemized deductions for 2020 was 1. Charitable contributions, 2. Interest paid, in particular mortgage interest, 3. Taxes paid, primarily SALT and sales taxes, 4. Qualified business income deduction, 5. Medical and dental expenses, and 6. Gambling losses and other unlimited miscellaneous deductions. Charitable contributions increased 7.7% for 2019 to $204.7 billion, despite the number of returns with these contributions declining by 12.6%. This was partially due to the removal of adjusted gross income limitations for most cash contributions made in 2020. Interest paid decreased 13.9% from the previous year to $178.6 billion, with mortgage interest accounting for 88.4% or $157.8 billion of the total interest paid deduction. Prior to 2018, the total taxes paid, which included state and local income and sales taxes, were the largest itemized deduction. However, tax law changes limited the deductions after 2018 to a combined total deduction for state and local income and sales and property taxes of $10,000 and $5,000 for married filing separately. Thus, for 2020, after the limit, total taxes paid decreased another 10.6%
to $124.2 billion. This was followed by the qualified business income deduction, which was reported by 22.8 million taxpayers for 2020 and represented deductions amounting to $166 billion. Next, deductions for medical and dental expenses after the adjusted gross income limitation, reported by 3.9 million taxpayers and representing $77 billion in deductions. And finally, gambling losses and other unlimited miscellaneous deductions, reported by 702,000 taxpayers and representing $21 billion in deductions. Hopefully, this provides some added perspective with respect to the standard deduction as opposed to the itemized deductions for purposes of individual income tax return preparation and filing, for which the IRS's own statistical data can provide some very insightful information for the discerning taxpayer. Thank you.
IRS business expenses, where your home is used for business purposes. Where a taxpayer uses part of their home for business, the taxpayer may be able to deduct expenses for the business use of their home. These expenses may include mortgage interest, insurance, utilities, repairs, and depreciation. According to the Internal Revenue Service, to qualify to claim expenses for the business use of their home, the taxpayer must meet both of the following tests. 1. The business part of their home must be used exclusively and regularly for the taxpayer's trade or business. And 2. The business part of their home must be A. The taxpayer's principal place of business, or B. A place where they meet or deal with patients, clients, or customers in the normal course of their business or trade, or C. A separate structure not attached to their home used in connection with the taxpayer's trade or business. It is the IRS's position that a taxpayer generally does not have to meet this exclusive use test for the part of their home that the taxpayer regularly uses either as a daycare facility, or 2, for the storage of inventory or product samples, provided that the following tests are satisfied. The taxpayer sells products at wholesale or retail at the trade or business. B. The taxpayer keeps the inventory or product samples in their home for use in their trade or business. C. The taxpayer's home is the only fixed location of their trade or business. D. The taxpayer uses a storage space on a regular basis. And E. The space used is a separately identifiable space suitable for storage. A taxpayer's home office qualifies as a principal place of business if they meet the following requirements. 1. The taxpayer uses their home office exclusively and regularly for administrative or management activities of their trade or business. 2. The taxpayer has no other fixed location where they conduct substantial administrative or management activities of their trade or business. Meanwhile, should the taxpayer have more than one business location, determine the principal place of business based on the following factors. A. The relative importance of the activities performed at each location. B. If the relative importance factor does not determine their principal place of business, one must consider the time spent at each location. The following chart provided by the IRS to help determine can you deduct business use of the home expenses can prove particularly beneficial. One starts by asking, is part of your home used in connection with a trade or business? Where the answer is no, then there is no deduction. If yes, you go on to the next step. Are you using the part of your home as an employee? Here, if the answer is yes, once again, no deduction. But if no, you continue on. Is the use regular and exclusive? Here, if the answer is no, once again, no deduction. And yes, we continue on. Is it your principal place of business? If the answer is yes, then the deduction is allowed. If no, we must then ask, do you meet patients, clients, or customers in your home? Here, if the answer is yes, then deduction is allowed. If no, you must ask the final question, is it a separate structure? And here again, yes, then the deduction is allowed. If no, there is no deduction. The taxpayer then needs to proceed to determine the deductibility of the particular expense, with the following table providing the IRS's perspective as to deductibility. Types of expenses. Direct expense. Expenses only for the business part of your home. Examples, painting or repairing only in the area used for business. Deductible in full. Exception, may be only partially deductible in a daycare facility. Indirect expense. Expenses for keeping up and running your entire home. Examples, insurance, utilities, and general repairs. Here, deductibility is based on the percentage of your home used for business. And finally, unrelated expenses. Expenses only for the parts of your home not used for business. Examples, lawn care or painting a room not used for the business. Here, there is no deductibility. And as noted in the tip, IRS Form 8829 and the worksheet to figure the deduction of business use of your home is how one proceeds to optimize one's business expenses in the home in conformity with the IRS's prerequisites. One then proceeds to look at the worksheet, looking both at determining the percentage use of one's home used for business purposes by taking the area of the home used for business and dividing it by the total area of the home to give one the percentage, and then looking through a series of allowable deductions and making determinations based on the IRS's worksheet as to direct expenses and indirect expenses based on the prior table that we went through. Furthermore, the IRS does provide an optional safe harbor method which doesn't rely upon the taxpayer determining the amount of deductible expenses attributable to certain business uses of a principal residence during the tax year, without calculation, allocation, and substantiation of actual expenses. Instead, the optional safe harbor method is limited to a maximum of $1,500 per year based on $5 per square foot for up to 300 square feet. Under this method, the taxpayer is entitled to claim their allowable mortgage interest, real estate taxes, and casualty losses on their home as itemized deductions on Schedule A, Form 1040. The taxpayer is not required to allocate these deductions between personal and business use, as is required under the regular method. However, it also needs to be noted that if the taxpayer uses the optional safe harbor method, they cannot depreciate the portion of their home used in a trade or business. Business expenses unrelated to the home, such as advertising, supplies, and wages paid to employees, remain fully deductible. All of the requirements previously discussed as to the business use of their home still apply. For more information on the deduction for business purposes of your home, including the optional safe harbor method, one should refer to IRS Publication 587. Taxpayers must also remember that if they were entitled to deduct depreciation on the part of their home used for business, they cannot exclude the part of the gain from the sale of their home that equals any depreciation they deducted or could have deducted for periods after May 6, 1997. This remains but a very brief summary of the IRS's available deduction for business use of one's home, including the optional safe harbor method, with IRS Publication 587 being an important resource for further information, together with obtaining professional advice from knowledgeable professionals. Thank you.
Travel expenses, according to the IRS. The Internal Revenue Service sets out their stated position with respect to travel expenses and their deductibility in IRS Publication 463. Although for purposes of this particular video, we are going to be focusing upon the broad term of travel expenses, without going into the technical aspects as to how much can be deducted, etc. It should also be noted that IRS Publication 463 of itself, for which we are providing but a brief look at, is itself merely an introductory overview, with the specifics actually needing to be discerned from the United States Internal Revenue Code and court decisions, in particular those of the U.S. Tax Court and appellate decisions, typically in conjunction with seasoned tax professionals, to get down to the specifics. Nonetheless, from the standpoint of an average taxpayer, IRS Publication 463 is solid guidance with respect to travel expenses and their deductibility. Proceeding forward, the formative question is what exactly is a travel expense? And for that, the IRS states that for tax purposes, travel expenses are the ordinary and necessary expenses of traveling away from home for the taxpayer's business, profession, or job. The IRS proceeds to further clarify these two requisite components. First, an ordinary expense is one that is common and accepted in that particular taxpayer's trade or business. And second, a necessary expense is one that is helpful and appropriate for that particular taxpayer's business, with a further consideration being that an expense does not have to be required to be considered necessary. Now, prior to proceeding to certain examples of permissible travel expenses for tax deduction purposes, the IRS addresses two essential components. One, traveling away from home, and two, the taxpayer's tax home. With respect to traveling away from home, the IRS position is that this arises where A, the duties of the taxpayer require them to be away from the general area of their tax home substantially longer than an ordinary day's work, and B, the taxpayer needs to sleep or rest to meet the demands of their work while away from home. As for a taxpayer's tax home, the IRS position is that the taxpayer's tax home is their regular place of business or post of duty, regardless of where they maintain their family home, and includes the entire city or general area in which their business or work is located. Where the taxpayer does not have a regular or a main place of business because of the nature of their work, then their tax home may be the place where they regularly live. So what exactly are the more common travel expenses, and how does the IRS view the deductibility of those costs, to the extent that they meet the criteria, such that we look at some of the key examples identified by the IRS, with us merely scraping the surface as to what permissible travel expenses constitute, with there being considerably more to address in most instances, including what is the impact of varying circumstances and what amount is actually deductible. Transportation involves travel by airplane, train, bus, or car between the taxpayer's home and their business destination, with distinct rules for waterborne travel. Taxi, commuter bus, and airport limousine. Fares for these and other types of transportation that takes the taxpayer between 1, the airport or station and their hotel, and 2, the hotel and the work location of their customers or clients, their business meeting place, or their temporary work location. Automotive operations and maintenance. Automotive costs arising from traveling away from the tax home of business. The taxpayer can deduct actual expenses or the standard mileage rate, as well as business-related tolls and parking. If the taxpayer rents a car while away from home on business, the taxpayer is limited to deducting only the business use portion of the expenses. Meals and lodging. The taxpayer's lodging and non-entertainment related meals, provided the business trip is overnight or long enough that they need to stop for sleep or rest to properly perform their duties. Telecommunications. Business phone calls by the taxpayer while on the business trip. This includes business communication by fax machine or other communication devices. The IRS provides a wealth of other points of consideration with respect to travel expenses, including employees. The taxpayer can deduct the travel expenses of someone who goes with them if that person, 1, is their employee, 2, has a bona fide business purpose for the travel, and 3, would otherwise be allowed to deduct the travel expenses. Business associates. If a business associate travels with the taxpayer and meets the conditions, 2, has a bona fide business purpose for the travel, and 3, would otherwise be allowed to deduct the travel expenses, the taxpayer can deduct the travel expenses they have for that person. A business associate is someone with whom the taxpayer could reasonably expect to actively conduct business. A business associate can be a current or prospective customer, client, supplier, employee, agent, partner, or professional advisor. Bona fide business purpose. A bona fide business purpose exists if the taxpayer can prove a real business purpose for the individual's presence. Incidental services such as typing notes or assisting and entertaining customers aren't enough to make the expenses deductible. With respect to record keeping, it is the Internal Revenue Service's position that the taxpayer should keep adequate proof, an account book, diary log, statement of expense, trip sheets, or similar record. The taxpayer is also expected to keep such documentary evidence that, together with their record, will support each element of an expense. As we've indicated at the outset, this is but the briefest of overviews of travel expenses according to the Internal Revenue Service, with publication 463 being an essential starting point to the taxpayer's analysis of permissible travel expenses. Thank you.
What is IRS Direct File? IRS Direct File is a new filing option for U.S. taxpayers that is provided through a web-based service that allows U.S. taxpayers to file directly with the Internal Revenue Service for free. IRS Direct File works on mobile phones, laptops, tablets, or desktop computers, thereby allowing for optimal availability. IRS Direct File was designed to lead U.S. taxpayers through a step-by-step process via a series of questions to prepare their U.S. federal income tax return. Once a taxpayer has completed their federal income tax return, the Direct File system automatically guides them to complete their state tax filings if they have a state tax obligation. Direct File began as a pilot program for the 2023 tax filing year, and after receiving overwhelming positive reviews from taxpayers, was made available in 25 states for the 2024 tax filing year, which are filed in calendar year 2025. IRS Direct File features a data import tool that allows U.S. taxpayers to automatically import data from their IRS account, including personal information, the taxpayer's identity protection PIN, and some information from the taxpayer's W-2. Live chat is also available with IRS Direct File, and users can opt into additional authentication and verification processes, which allows customer service representatives to provide more information. In addition, there is a chatbot to help guide users through the eligibility checker. Taxpayers can use IRS Direct File if they have certain types of income outlined in more detail in the Direct File fact sheet, such as reporting retirement income, contributions, or rollovers, while already being capable of supporting taxpayers claiming the Earned Income Tax Credit, the Child Tax Credit, and the credit for other dependents. IRS Direct File is also designed to cover taxpayers claiming the Child and Dependent Care Credit, Premium Tax Credit, credit for the elderly and disabled, retirement savings contribution credits, health savings account deductions. The United States Treasury Department estimates that more than 30 million taxpayers are presently eligible to use IRS Direct File across the following 25 states: Alaska, Arizona, California, Connecticut, Florida,
Idaho, Illinois, Kansas, Maine, Maryland, Massachusetts, Nevada, New Hampshire, New Jersey, New Mexico, New York, North Carolina, Oregon, Pennsylvania, South Dakota, Tennessee, Texas, Washington State, Wisconsin, and Wyoming. More information about IRS Direct File is available at the Internal Revenue Service's website, irs.gov. For more informative videos on tax matters and related topics, we welcome you to subscribe to our channel as well as liking this video. Thank you. What is IRS Form W-2 Wage and Tax Statement? The Internal Revenue Service's Form W-2 Wage and Tax Statement is a required employer submission with respect to its employees for every employer that is engaged in a trade or business that pays remuneration, including non-cash payments of $600 or more for the year, and thus includes amounts paid that results in the withholding of any income, Social Security, or Medicare tax for services performed by the employee. The employer's criteria for preparing and filing a W-2 is that the employee has either had income, Social Security, or Medicare tax withheld, or income tax would have been withheld if the employee had claimed no more than one withholding allowance or had not claimed an exemption from withholding on Form W-4, Employee's Withholding Allowance Certificate. The employer is required to mail out an employee's W-2 on or before January 31st. This deadline provides the employee with at least 2 months to prepare their individual income tax return on IRS Form 1040, given the April 15th individual income tax filing deadline. The principal purpose of the W-2 is to settle an employee's wages and salary information, in addition to the amounts that the employer remitted to the government for federal, state, and other taxes. An employee's W-2 also provides other important employment details that are relevant to an employee's tax computations, including contributions to a retirement plan, tax-deferred annuity, or health insurance, the receipt of dependent care benefits, and other employment-related information. Such employment-related information enables the employee to properly prepare their individual income tax return, such as certain retirement contributions not being taxable. Where the W-2 reveals that an employee has withheld more taxes than required pursuant to the employee's preparation of their individual income tax return, the employee can be entitled to a refund for the excess amount that has been paid to the IRS by their employer. As such, the W-2 has considerable value to an employee, given the tendency of employers to withhold and remit a greater amount of taxes on behalf of their employees, typically as a result of their not including the credits and deductions that the employee is entitled to claim. Thank you.
W-2 Breakdown. Understanding IRS Form W-2 Wage and Tax Statement. In this particular video, we look to break down the Internal Revenue Service's Form W-2 Wage and Tax Statement, so as to understand the specific contents that are set out by the employer as to employment compensation, deductions, and withholdings for services performed by the employee. Boxes A to F. These are the employee and employer identification boxes, including the employee's Social Security number, Box A, employee's name, Box E, and employee's address, Box F, together with the employer's identification number, EIN, Box B, employer's name and address, Box C, and employer's control number, Box D, if any. Boxes 1 and 2. Box 1 shows the employee's total taxable income paid by their employer, including taxable wages, tips, prizes, and other compensation, as well as any taxable fringe benefits. It does not include elective deferrals to retirement plans, pre-tax benefits, or payroll deductions, such that it is not uncommon for the amount to be less than the amounts included at boxes 3 and 5. Box 2 shows the total amount of federal income tax withheld by the employer on their employee's behalf, based upon the employee's prior elections set out in IRS Form W-4 Employees Withholding Certificate. Boxes 3 to 6. Boxes 3 and 5 show the amount of the employee's earnings subject to Social Security and Medicare taxes, respectively, noting that Social Security wages do not include Social Security tips and allocated tips, whereas Medicare wages are inclusive of tips. Boxes 4 and 6 show the amount of Social Security and Medicare taxes withheld. As previously indicated, the amounts in Box 3 and 5 might be different from the amount in Box 1 due to the exclusion from Box 1 of elective deferrals to retirement plans, pre-tax benefits, or payroll deductions. As the Social Security tax is a flat tax upon employers and employees, each pay 6.2% of prescribed earnings up to the taxable maximum of $160,200 in 2023, while the self-employed paying 12.4%. The amount in Box 4 should be 6.2% of the amount in Box 3, subject to current year's maximums. The Medicare tax is also a flat tax upon employees and employers. Each pay 1.45% of prescribed earnings with no maximum, while the self-employed paying 2.9%. Thus, the amount of Box 6 should be 1.45% of the amount in Box 5. Boxes 7 and 8. Where an employee earned money through tips, Box 7 shows how much has been reported in tips, while Box 8 shows how much money the employer allocated to the employee in tips. Box 9. The box once reported an employer benefit which no longer exists. The box is grayed out as a result. Box 10. The total dependent care benefits under a dependent care assistance program paid or incurred by an employer for their employee is reported in Box 10. Box 11. If an employer receives certain deferred compensation income from their employer from a non-qualified plan, this information is required in Box 11. The purpose of Box 11 is for the Social Security Administration to determine if any part of the amount reported in Box 1 or Box 3 and/or 5 was earned in a prior year. The Social Security Administration uses this information to verify that they have properly applied the Social Security earnings test and paid the correct amount of benefits. Box 12. If an employee received other types of compensation or reductions to the taxable income, these were reported in Box 12 series. The employer will utilize a single or double letter code corresponding to each, the particulars of which can be found in Form W-2 Reference Guide for Box 12 codes, covering aspects such as contributions made to a 401k plan, designated Roth contributions, health savings account contributions made by their employer, or the taxable cost of group term life insurance over $50,000. Box 13. Box 13 reports whether the employee worked as a statutory employee not subject to federal income tax withholding, participated in employer-sponsored retirement plans such as a 401k or 403b, among other qualifying arrangements, or received sick pay through a third-party source like an insurance policy. Box 14. If there is other tax information for the employee that doesn't fit into the other W-2 boxes, the employer may use Box 14 to report these items. Such examples include state disability insurance taxes withheld, union dues, union payments, health insurance premiums deducted, and more. Box 15 to 20. An employer uses Box 15 to 20 to report state and local income tax information with a two-letter abbreviation for the name of the particular state alongside the employer's state identification number assigned by the state. These boxes can report wages for 2 states and 2 localities. If the employer needs to report information for more than 2 states or localities, the employer needs to prepare additional Form W-2s for those employees. Thank you.
IRS extension. Getting an extension beyond the IRS's personal filing deadline. If you are unable to complete and file your federal income tax return by the April deadline, the IRS does provide taxpayers with the opportunity to request an extension. An extension gives a taxpayer until the middle of October of the current year to file their most recent federal income tax return. The Internal Revenue Service provides two primary avenues to request an automatic extension in advance of the April filing deadline, with taxpayers either using IRS Free File at irs.gov/freefile to request an automatic filing extension, or filing IRS Form 4868 application for automatic extension of time to file. However, taxpayers need to be crystal clear as to the limitations of a filing extension, as it is not an extension to pay taxes. If the taxpayer owes taxes, the IRS treats the April date as the expected payment date and looks to calculate and levy interest and potentially penalties from that date onwards. As such, there is no reprieve from tax liability, only filing, such that taxpayers should not believe that attaining an extension is not without potential cost consequences. As the IRS clearly states in its discussions of filing extensions, taxpayers need to be aware that an extension of time to file one's income tax return does not grant the taxpayer any extension of time to pay their taxes. The taxpayer should estimate and pay any owed taxes by the regular deadline to avoid possible penalties. The taxpayer must file their extension request no later than the regular due date of the federal tax return. The IRS likes to emphasize its suggestion that taxpayers seeking a filing extension should pay all or part of their estimated taxes along with the extension request, which invariably tends to be in their personal best interest. Thank you.
Crypto tax reporting, IRS Form 8949. Reporting taxable events involving cryptocurrency and other digital assets to the Internal Revenue Service, IRS, is undertaken on IRS Form 8949. Sales and other dispositions of capital assets. Having previously explored what the IRS views as taxable cryptocurrency transactions in prior videos, with the links contained in the description to this video, we now look at the actual IRS Form 8949. Cryptocurrency tax reporting on Form 8949 is broken out into two primary tables. 1. Short-term gains and losses, and 2. Long-term gains and losses. The distinction between the two is whether the taxpayer held a subject cryptocurrency or other digital asset for 1 year or less, being short-term, or more than 1 year, being long-term. The taxpayer also needs to specify whether or not they received an IRS Form 1099-B, and whether or not the form was reported to the IRS. Nevertheless, with crypto exchanges not being legally obligated to provide 1099-Bs for crypto transactions, receiving a 1099-B remains quite rare, such that most crypto tax reporting involves checking off Box C for short-term holdings and Box F for long-term holdings. Having determined the length of time holding the particular cryptocurrency and thus the applicable table, one proceeds to complete a row for each digital asset that was acquired on a distinct date and sold on a distinct date. This means that Bitcoin acquired on April 3rd and April 18th needs to be reported on separate rows, as must sales on September 21st and October 19th. Completing the row begins with identifying the form of digital asset in column A, such as Bitcoin, Ethereum, Tether, Binance Coin, USD Coin, etc., together with the number of units divested. In column B, one enters the date that the digital asset was acquired, and in column C, the date that the digital asset was sold or otherwise disposed of. Column D sets out the proceeds, sale price, for the cryptocurrency, with column E setting out the cost or other basis for the cryptocurrency when it was originally acquired. Column F and column G provide for certain adjustments. However, these tend to be exceedingly rare for crypto transactions, with these adjustments being primarily for other capital asset sales that also are reported on this tax form, with the instructions for IRS Form 8949 outlining the available adjustments. Finally, in column H, one sets out the resulting gain or loss by subtracting the cryptocurrency's original cost or other basis in column E from the transaction proceeds, sale price in column D, subject to any applicable adjustment from column G. One then totals columns D, E, G, and H for each of the tables, with the reporting of the total short-term gain or loss being entered in Schedule D at line 3, unless a transaction was reported on IRS Form 1099-B such that it is entered at either line 1B or 2. For a long-term gain or loss, it is entered on Schedule D at line 10, unless a transaction was reported in IRS Form 1099-B such that it is entered at either line 8B or 9. This is the stated expectation of the Internal Revenue Service, which needs to be reported for all of one's cryptocurrency transactions, as they each constitute a taxable event. Thank you.
What is IRS Tax Form 1040-SR, U.S. Income Tax Return for Seniors? Internal Revenue Service Tax Form 1040-SR is a simplified income tax form that is only available to U.S. taxpayers who are 65 or older as of January 2nd of the tax filing year, regardless of whether or not the individual taxpayer is retired. The qualifying criteria is the taxpayer's age, as opposed to their job status, such that a taxpayer is not entitled to use IRS Form 1040-SR simply because they are a retiree if they are under 65 years of age. As such, even though a taxpayer's income sources include Social Security, pensions, and investment income, but they are under 65, they must continue using the standard U.S. income tax return, being IRS Form 1040. The Internal Revenue Service developed Form 1040-SR pursuant to the Bipartisan Budget Act of 2018 to provide U.S. seniors with an income tax form that uses a larger print and includes a standard deduction table directly on the form so that seniors can quickly look up their standard deduction amounts. IRS Tax Form 1040-SR uses the same line items and instructions as the standard Form 1040, with the intention of making income tax filing easier for senior citizens. Who can file IRS Tax Form 1040-SR, U.S. Income Tax Return for Seniors? Internal Revenue Service Tax Form 1040-SR is a simplified income tax form that is only available to U.S. taxpayers who are 65 or older as of January 2nd of the tax filing year, regardless of whether or not the individual taxpayer is retired. The qualifying criteria is a taxpayer's age, as opposed to their job status, such that a taxpayer is not entitled to use IRS Form 1040-SR simply because they are a retiree if they are under 65 years of age. As such, even though a taxpayer's income sources include Social Security, pensions, and investment income, but they are under 65, they must continue using the standard U.S. income tax return, being IRS Form 1040. Age is the exclusive criteria for filing IRS Tax Form 1040-SR, with anyone below the age of 65 as of January 2nd of the tax filing year being obligated to continue filing IRS Tax Form 1040. With those over 65, senior citizens, having the choice of using either the standard Form 1040 or the larger print Form 1040-SR. Which gambling winnings do you report to the IRS? Whether it is casino gambling, slot machines, online gambling, poker tournaments, bingo, keno, lotteries, sweepstakes, wagering pools, horse racing, dog racing, jai-alai, or other wagering, betting, or gambling. To report gambling winnings on IRS Form W-2G, it is best to look at the IRS instructions for Forms W-2G and 5754.
Generally, it is required to report gambling winnings on IRS Form W-2G if 1. The winnings not reduced by the wager are $1,200 or more from a bingo game or slot machine. 2. The winnings reduced by the wager are $1,500 or more from a Keno game. 3. The winnings reduced by the wager or buy-in are more than $5,000 from a poker tournament. 4. The winnings, except winnings from bingo, slot machines, Keno, and poker tournaments, reduced at the option of the payer by the wager are A. $600 or more, and B. at least 300 times the amount of the wager, or 5. The winnings are subject to federal income tax withholding, either regular gambling withholding or backup withholding. More specifically, A. Poker tournaments. File Form W-2G for each person to whom you pay more than $5,000 of winnings, reduced by the amount of wager or buy-in from each poker tournament you have sponsored. Winnings and losses of the participant from other poker tournaments you have sponsored during the year aren't taken into account in arriving at the $5,000 amount. B. Bingo, Keno, and slot machines. File Form W-2G for every person to whom you pay $1,200 or more in gambling winnings from bingo or slot machines, or $1,500 or more from Keno after the price of the wager for the winning Keno game is deducted. If the winnings aren't paid in cash, the fair market value of the item won is considered the amount of winnings. Total all winnings from all wagers made during a single bingo or Keno game to determine whether the winnings are reportable. Winnings and losses from other wagering transactions aren't to be taken into account in arriving at the $1,200 or $1,500 figure. C. Sweepstakes, wagering pools, and lotteries. File IRS Form W-2G for each person to whom you pay $600 or more in gambling winnings from a sweepstakes, wagering pool, or lottery, including a state-conducted lottery, if the winnings are at least 300 times the amount of the wager. The wager must be subtracted from the total winnings to determine whether withholding is required, and at the option of the payer to determine whether reporting is required. The wager must be subtracted at the time of the first payment. This requirement applies to church raffles, charity draws, etc. D. Horse racing, dog racing, jia-li, and other wagering transactions. File IRS Form W-2G for each person to whom you pay $600 or more in gambling winnings, if the winnings are at least 300 times the amount of the wager. If the person presenting the ticket for payment is the sole owner of the ticket, complete IRS Form W-2G showing the name, address, and TIN of the winner. If regular gambling withholding is required, the winner must sign Form W-2G under penalties of perjury, stating that he or she is the sole owner and the information listed on the form is correct. E. Withholding in Forms W-2G for multiple winners. If more than one person shares the winnings from a single wager, the total amount of the winnings minus the amount wagered will determine the amount of the proceeds for purposes of reporting and withholding. Do not allocate winnings to each winner before determining whether the withholding or reporting thresholds were reached. For more insights into taxation of gambling and other tax and business topics, we welcome you to subscribe to our channel. Thank you. Whether you win or lose at gambling, it's important that you understand the IRS's position with respect to taxes and your tax liability associated with those winnings or losses from your trip to the casino. As such, it's important to look at 5 critical tips that the IRS has provided with respect to gambling income and losses. Now, it's a common misconception that unless you receive an IRS Form W-2G, certain gambling winnings, at a casino, your gambling winnings don't have to be reported at the end of the year on your federal income tax return. However, like any other income, regardless of whether or not documentation was provided at the time it was earned or won, all income must be reported on your federal income tax return. Furthermore, you can offset your gambling winnings with any losses that you may have incurred on the amount of your gambling winnings. Now, the IRS does provide 5 tips or suggestions that every taxpayer who gambles should know. Tip number 1. Gambling income includes, but is not limited to, winnings from lotteries, raffles, horse races, and casinos. It includes cash winnings and the fair market value of prizes such as cars and trips. Tip number 2. If you receive a certain amount of gambling winnings, or if you have any winnings subject to federal income tax withholding, the payer is required to issue you an IRS Form W-2G. Tip number 3. Generally, you report all gambling winnings on the other income line of IRS Form 1040, U.S. Individual Income Tax Return. Tip number 4. You can claim your gambling losses up to the amount of your winnings on IRS Schedule A to Form 1040, itemized deductions under Other Miscellaneous Deductions. You must report the full amount of your winnings as income and claim your allowable losses separately. You cannot reduce your gambling winnings by your gambling losses and report the difference. Your records should also show your winnings separately from your losses. Tip number 5. You should keep accurate records. If you are going to deduct gambling losses, you must have receipts, tickets, statements, and documentation, such as a diary or similar record of your losses and winnings. Reference should be made to IRS Publication 529, Miscellaneous Deductions. For more details about the type of information you should write in your diary and what kinds of proof you should retain in your records. These are but some of the very general tips that are provided by the Internal Revenue Services with respect to gambling winnings and losses and how they are to be claimed both as earnings and losses. For more information on these tax aspects and other business and financial matters that can be of relevance to yourself, we welcome you to subscribe to our channel. Thank you.